steering the Federal Reserve's target, along with signs of economic weakness here in the U.S. Recent U.S. manufacturing data revealed a further decline in June. Also, political risks in the U.S. are becoming more pronounced, with uncertainties surrounding the U.S. presidential election. This morning, I'm joined by Ted Thatcher, president of Bright Lake Wealth Management. Ted, thank you so much for joining me today. So, first and foremost, the idea of Wall Street versus Main Street, we're seeing what can be characterized as a tale of two cities. U.S. stocks did hit new record highs this year, while Americans are seeing elevated prices and stubborn costs. So, why are we seeing two different realities here?
Well, firstly, Romney, it's great to be with you. And I do think there is quite a discrepancy. If we look at Wall Street, the markets are at all-time highs, driven very much primarily by big technology, namely NVIDIA, which we can talk about. And I always then come back to, well, what is the average American feeling day to day? Are they feeling those highs? I mean, maybe they're seeing them in their retirement accounts and therefore the value of their financial assets potentially increased. But the truth is for most Americans, their savings has dwindled, and the effects inflation have been so substantial. I would argue those things can only be so separated for so long before there has to be some level of, I'll say reckoning, maybe that's too strong of a word, but before those things kind of come back to a more even place, if that makes sense.
And Ted, we are keeping an eye on the Fed's trajectory as we head into the second half of this year. Powell is speaking this morning at the ECB Forum on Central Banking, and he'll be testifying on Capitol Hill next week. So, what are you listening for when it comes to Fed official commentary? And of course, ahead of the jobs report, what are you looking for in those numbers?
Well, I think that what's happened, especially over the last 18 months, really is the rate of inflation has very much been dictating Fed policy in terms of the rate hikes, rather than Fed policy dictating what's happened with inflation. And I think ultimately that has had to occur, or has occurred the way that it has, because of the print and spend policy that our government has entailed across, of course, everything that happened with COVID. Many would argue for quite good reason, and I think that that's a fair statement, but also even on the follow-on, spending packages that we've seen. And so ultimately, I think that we have to decide as a country if the level of spending that we're seeing is sustainable long term. And so I think what's happened is we came into 2024, if you remember, Jerome Powell at the end of December in 23 at the meeting they had there, mentioning and hinting at as many as 3 plus 4 potentially. And I remember the futures markets pricing in at one point a probability of 7 rate hikes this year. And I just don't think that Jerome Powell has been able to actually operate with the intention he had this year. We had that spike in April. The inflation rate really did peak up. Obviously, in May, it came in at break even, and I think the Fed was able actually to take a bit of a sigh of relief. But what I am guessing at this point is because of what Jerome Powell said earlier, like very early this year and late last year, he doesn't want to be wrong this time. And so he's been kind of putting out these statements that are quite hawkish. At the most recent Fed meeting, they said they wanted to maintain rates where they're at. I think he's going to wait to give us a clue that they really will lower until he's certain they can do so. If we look at the futures markets right now, we're expecting a rate decrease sometime in September, which I think is also reasonable going into an election cycle and the political pressure involved there as well.
And Ted, you brought up a lot of key points there, but as you mentioned, it is a U.S. presidential election year, and the timing of the remaining Federal Reserve meetings this year are being closely watched. But earlier you mentioned NVIDIA, so I do want to touch upon that. The S&P 500 is up over 14% year to date, and IT as well as communication services are up over 25%, while areas like real estate, materials, and consumer discretionary are lagging. So, given everything we've seen so far this year, where are the opportunities?
It's a great question. So I think first and foremost that patient investors are often rewarded. And so at the end of the day, my cash is paying me over 5% right now, Remy. I can't be upset about that. And if I get a benefit in that measure for being patient, I think that anyone should be comfortable with that. Now, that aside, you're absolutely correct. IT, namely NVIDIA, big tech, has driven the market returns this year. And so I think many investors have heard the phrase, let your winners ride. And so whenever you see a company like NVIDIA hit the absolute highs, you could look at the standards of deviation and the growth that they've seen. It's meteoric, really. And so I think that there's a temptation not to want to go lever in to, maybe a new big position into a company like that. And I think that that's reasonable. But as we've seen history teach us, it is often the fact that if we let our winners ride, it will actually end up meaning a great return for us. And with where the market's at, with everything happening with the H100s, the hardware that an NVIDIA is putting out, and the effect that it has on the technology environment with AI and the associations there, I think that there are some good arguments to be made by very intelligent folks in technology that the H100 as it sits today isn't going to be the perfect application for every AI implementation in the future. But NVIDIA has such a head start on all of the follow-on improvements. They have such a head start in terms of being so far ahead of their competition. It's hard not to think that at least for a little while here, they're going to keep roaring and ripping. So I do think that there's a potential of just, continuing the opportunity we see there, especially if you have a position, I'd hold on to it, at least very likely. Now, for new opportunities, because so much of the market has been driven by big tech's performance, it's meant that mid cap and small cap companies have kind of been middling along this year. But if we do believe that there's going to be a lowering interest rate environment, starting maybe later this year, potentially early next year, I think that the average winner there is going to be the mid and small cap companies. And so if we're looking for some opportunities, if we're willing to go through a little bit of kind of some doldrums here, I think ultimately when the market does turn in terms of interest rates, that those will be benefited as well.
Okay, Ted. Well, thank you so much for joining me on this Tuesday morning and have a happy 4th of July.
Thank you.